Hello, everybody. Welcome to the Covenant August video newsletter. My name is Carl Eggers, and in this video, we are going to cover a few different things. Number one, we're going to cover the progress of the stock market or the lack thereof. We're also going to give you an update on trade, which of course impacts the stock market, and also the economy. We're continuing with our good but not great thesis on the economy. We'll also discuss the Federal Reserve, which is having a big impact on the financial markets because they have had a major shift, one that we have not seen in our lifetimes. And that leads us to plummeting interest rates. Yeah, interest rates continue to go down. If you thought you could refinance your house a year ago, 2 years ago, 5 years ago, 10 years ago, surprisingly enough, you can still do that today. So we're going to talk about all of that in this video. All right, so as we always do, let's start off looking at the Standard & Poor's 500, and there hasn't been much progress. Yes, we are still near all-time highs, but if you look at this picture, you can see from really the start of 2018 all the way until now, we've essentially moved sideways with a lot of volatility. And of course, that volatility is primarily due to tariffs. That's when tariffs were first introduced to us by President Trump. And since that point, we continue to get volatility. And I'm not going to put when this occurs, but every time we have peaked and started to fall, you will notice that the tariffs have either been ratcheted up or they've been implemented, or the trade talks have broken down with China. Conversely, when trade talks are going well and the tariffs are being delayed or put off or reduced, the market tends to rebound. And we've seen that just in the last couple of weeks, as a matter of fact. Now, as we zoom in, we do see some recent volatility, again, due to tariffs. And when we get those periods of volatility, it is interesting to note the media likes to hype up volatility, right? They run specials, they do breaking news, there's banners flashing. And of course, CNBC is notorious for running a markets in turmoil special that evening of the volatile markets or the downdraft in the markets. Just recently, we had that happen again. And so the chart you're looking at comes from Sentiment Trader, and they do a great job. Every red dot you see, which is laid on top of the Standard & Poor's 500 from 2010 until present, every red dot represents one of those markets in turmoil specials. So they take away their evening programming, have a live report, lots of different people on the screen talking about the crisis we're in, and markets are in turmoil. And of course, you can see every one of those red dots has been a buying opportunity, not a selling opportunity. So high correlation there, and we just recently had a markets in turmoil indicator. Now, the reason we are having the markets in turmoil is because we've had some recent volatility. And on August 5th, when that occurred, it was the 6th largest Dow point drop ever. That is a scary headline until you look at it in percentage terms. And Ryan Dietrich gave us the stat that this was the 435th largest percentage drop ever. So point drop, it was a big Dow drop. Percentage-wise, it was just another day. 2 to 3% drops in a single day are very normal. In fact, Ben Carlson has a nice stat that shows that the S&P has been down 2% or worse in a single day 70 times just this decade. So we should get used to 2 to 3% down days. In fact, we should get used to drops in the stock market in the teens at some point during the year. This picture that I'm showing right now comes from JP Morgan. It's one of my favorite of all time. It goes all the way back to 1980, and it shows each bar on there shows what the Standard & Poor's 500 did in that calendar year, up or down. And you can see most of those are up, of course, and a few downs. But the red dots represent at some point during the year what the drop was. So, of course, there are plenty of years on there where you will see the red dot was down, only to see the final number was actually up. So if you had Rip Van Winkled it and went to sleep on January 1st, came back on December 31st, you made money without the heartache of watching it go down during the year. Now, the average drop they calculate has been over 13% at some point during the year. So when you get a year where you don't have that, that is the abnormality. You don't typically get years where the stock market only goes down 3 or 4% at one point. At some point, you're going to have a correction that tests your patience and tests also your strategies and makes you want to give up on your strategies. But longer term, these markets do tend to bounce back, and we should expect volatility from a stock portfolio. That is what this picture illustrates. Now, we go back to the picture of the Standard & Poor's 500 for a minute, and you will notice that, yes, there is volatility. Most of it in the last year and a half or so has been because of trade. Yes, the Federal Reserve, which we'll get to in a minute, has caused some of that. But at the same time, again, the most important thing right now going on seems to be trade. That's what gives us the volatility, both down and up, because volatility is a two-way street. And there's been some rumors that China's stalling to try to get to the election without a deal so that they can perhaps work with somebody else. There is also rumors that Trump is delaying it a little bit because he wants it to be a deal to get done closer to the election. And of course, these are all rumors. And we're also hearing that there could be in the works a mini deal or a smaller deal done, which could boost markets, and then perhaps a more comprehensive deal later down the road. And that's probably likely because we are dealing with intellectual property and theft of that, et cetera. So to get a real comprehensive deal, we've been saying all along would take months, if not potentially years. And so the progress we see on trade is what continues to boost the market. And then any setback in trade, you continue to see some pullback. Now we move on to the economy. And remember, the economy is really made up of 2/3 of the economy is the consumer. So if the consumer is doing well, you are doing well, you are spending and in pretty good shape, the economy tends to do well. And we are still seeing that. We are sticking with our good but not great theme regarding the economy. Now we're going to look at two charts specifically aimed at the consumer. And these two charts come to us via Foleynomics, which is Sean Foley, our resident economist in-house. We had an investment committee meeting just recently, got some fresh data from him, and we obviously take all that into consideration in any of our investment moves. And he noted that the 35-day government shutdown, which was the longest on record in 2018, affected really consumption because all those people that were out of work temporarily weren't spending. And so that affected the fourth quarter of 2018 and the first quarter of 2019. And you can see we have gotten that back. And so now we are seeing a boost in consumption. And you can see it's pretty high based on the rebound in the last couple of quarters. And also just lower inflation has helped contribute to that as well, because this is real consumption, meaning you take the inflation out of it or include it in it. So what is really going on, and as inflation's been dropping, this has helped the consumption numbers. Now, how are the consumers doing when it comes to their balance sheet? Well, if you look at overall debt compared to personal disposable income as a ratio, you will notice, which is the dark colored line, you will notice that it is higher today than in 2008, which doesn't sound great until we realize and we strip out the student loan debt, which is $1.6 trillion. The household balance sheet is in pretty good shape if you don't have that debt. Now, a lot of people do have that debt. One good thing about that, one positive note, is that about half of that $1.6 trillion in student debt is non-payment status. That means it's in school deferrals, forbearance, or just in a forgiven status. So the impact on consumption patterns is lower than otherwise would be indicated by this. So again, consumer debt's okay. The student loan debt is really the problem. But again, half of that is in non-payment status. All right, shifting quickly to the Federal Reserve. What a change of course for them. And remember, the Federal Reserve was in hiking mode late 2018. We're going to hike. The stock market and investors threw a hissy fit, seeing that the economy was starting to slow and the Federal Reserve looked out of touch. Lo and behold, they said we're going to pause. And then, of course, here recently, they have actually cut interest rates. And they don't seem to ever do this once and done. They seem to have a pattern of if they're raising, they're going to continue to raise. If they're lowering, they're going to continue to lower. We think they will continue to lower. And you did see the stock market bounce back after that acknowledgement early in the year. Remember, we had a really rough fourth quarter in 2018, and things bounced back in the first and second quarter of 2019. Now, interest rates have fallen dramatically. So you can see the picture of the Fed cutting rates. Let's shift over to the picture of the 10-year Treasury, which is really close to all-time low levels. So we're near 1.6% for a 10-year Treasury. You're going to lend your money to the government for 10 years and get paid 1.6% if you were to do that. Now, why are people continuing to do that around the world? Remember, so much money has to be allocated to bonds around the world. Our bonds in the U.S. look better relative to the rest of the world, who many of those countries, including Germany, have negative interest rates. So if you're having to put money in bonds, are you going to put it in one that has a pretty good economy, good but not great, or are you going to put it in an economy that may be slowing a little more and has negative rates? Most people are choosing the U.S. Treasury rates. And our dollar is stronger, which is another issue. But when rates fall this fast, it makes people on Wall Street a little nervous because is the bond market seeing a recession coming? Is that what's happening? So there's a little bit of panic, and you've seen some volatility in the stock market because of that. But take a look at this picture. Actually, falling rates, when they fall this fast, have been good for stocks. In fact, the average gain 1 year later, when interest rates have fallen as fast as they have recently, which is a whole several dates on this chart that show when that's happened, the one I'm circling here is the 1 year average return for the Standard & Poor's 500 has been just over 22%. So despite that fear of recession, stocks tend to do well simply because lower interest rates at the end of the day are going to grease the wheels. They are going to cause people to borrow. They're going to cause people to refinance, buy a new house, people to do real estate deals on borrowed money. That is what happens, which is why the Fed's lowering rates and why the 10-year Treasury yield is falling. And it does tend to be good for stocks. So that is very encouraging out there. But overall, as we go back to the picture of the Standard & Poor's 500, we're having some volatility. We still don't see signs of a bear market or recession as far out as we can see, but there's no doubt that the economy has slowed and it's more vulnerable now, especially to shocks. Remember, the government shutdown in the fourth quarter of 2018 was a shock. A shock could be any bit of thing. It could be geopolitical news headlines. It could be the trade war escalating. Those are things that could cause a further slowdown and cause a further recession and cause the stock market to sputter a little bit. But earnings season has been pretty good. The economy is still moving forward, and it's cruising along. Instead of 60 miles an hour, maybe it's cruising along at 20 or 30 miles an hour, but it is still moving forward. And again, we're not that far off from all-time highs. It's just we haven't made any meaningful progress. So if we can get progress on trade, earnings continue to go up, and global economies do stabilize, and we see some growth start to pick up a little bit, the stock market should continue higher over the next several months. But regardless, obviously, the stock market isn't the only game. There's the bond market, commodities, you have, domestic stocks, international stocks, and so a diversified portfolio is always key. And of course, your situation is very different than everybody else's. So we're primarily talking about the big macro picture here of what's going on, what's causing some of the volatility. And primarily, it's been two things, interest rates and trade. And I would weigh trade more than interest rates at this point is what's driving the day-to-day movement. All right, if you have any questions, let us know. And don't forget, you can always go to creatingricherlives.com. And that is the name of our newly reissued podcast, Creating Richer Lives, as well, which is available on the podcast store at Apple and Spotify and any place you get your podcasts. So take care, everybody.